What is Wall Street? The term Wall Street is used to describe a physical location. The street is in Lower Manhattan, home to the New York Stock Exchange, and many important financial institutions, many of which have been around for centuries. You can go to Wall Street and stand surrounded by offices that collectively control trillions of dollars in wealth. The term Wall Street is a metonymy for capital market finance. Wall Street is frequently used as a figure of speech to describe a person, institution, or activity tied to high finance and banking. If you look at an asset management company such as American Century Investments in Kansas City, it oversees more than $1 trillion, mostly through mutual funds and institutional relationships. American Century Investments is located in the heart of the Midwest, surrounded by plains a few miles out from its impossible-to-miss headquarters at the Country Club Plaza. It is nowhere near Wall Street physically, but it's very much a part of what people think of when they discuss the activity of portfolio managers, retirement plan administrators, and financial analysts. Wall Street, both the physical place and the metonymy, exist for three primary purposes. 1. To establish a market for institutions to raise capital through a centralized trading area that connects savers of capital with those who want to raise capital. Wall Street trading can come in many forms, including the issuance of bonds or by selling ownership in a business through the issuance of stock. This is a core reason why Wall Street is so important. It is what makes capitalism work, what moves money efficiently to its most productive uses. 2. To facilitate a secondary market for existing owners of stocks and bonds in order to find parties willing to buy their securities so they can raise cash. This makes markets more successful as investors have more confidence in the ability to use their portfolio as a source of liquidity, generally demanding lower risk premiums as a result. And 3. To assist those who wish to outsource the job of investing their capital so the client can focus on his or her primary career or activity. Sometimes this is done through a broker-dealer. Increasingly, this is done through a firm that is a registered investment advisor bound by a fiduciary duty to put the interests of the clients above the interests of the firm. This includes registered investment advisors that are primarily asset management companies. That way, if you are a high-earning, successful individual, such as a software developer or a doctor, you can pay someone else to handle your portfolio as you focus on generating more money, not reading 10K filings or mutual fund prospectuses. When most people think of the stock market, they are usually thinking about the secondary market, the buying and selling of existing shares of outstanding stock by individual investors through the retirement and brokerage accounts. The daily fluctuations in the major stock market indices such as the Dow Jones Industrial Average and the S&P 500. That fluctuation is what interests a lot of people, what causes otherwise intelligent individuals to become emotional and/or make financial mistakes that can have lifelong consequences. Wall Street and its many trading exchanges are repositories for investments across a variety of different security types. Exchanges allow institutions to issue securities for capital. The trading of these securities by investors is known as the secondary market. Overall, the support of government regulations and American institutions is what makes Wall Street a highly functional and reliable trading arena for investors to invest capital and grow their wealth over time. If you guys learned something new today, hit that like button and subscribe to the channel if you haven't already. Also, don't forget to hit that notification bell so you don't miss any of my upcoming videos. My name is Joshua Palabay, your friendly financial advisor. Stay awesome, and I'll see you guys in my next video.